Welcome to the basics of investing, where we'll explore how to make your money work harder for you. Investing is essentially putting your money into assets with the expectation of generating a profit over time. It's a powerful tool for building wealth, achieving financial independence, and securing your future. Unlike simply saving money, investing allows your capital to grow through interest, dividends, or capital appreciation. Before diving in, it's crucial to understand some fundamental concepts that underpin successful investing. First, let's talk about risk versus reward. Every investment carries some level of risk, but generally, higher potential returns come with higher risk. Understanding your personal risk tolerance is key to making informed decisions that align with your financial comfort. Next, diversification is vital. This means spreading your investments across various assets to minimize risk. Don't put all your eggs in one basket. A diversified portfolio can help cushion against market fluctuations. Finally, the power of compounding. This is when your earnings generate their own earnings, leading to exponential growth over time. Starting early allows compounding to work its magic, significantly boosting your long-term returns. Now, let's explore the different types of investments available to beginners. Stocks represent ownership in a company. When you buy a stock, you own a small piece of that business. Their value can increase or decrease based on company performance and market sentiment. Bonds are essentially loans made to governments or corporations. They are generally considered less risky than stocks. In return for your loan, you receive regular interest payments and your principal back at maturity. Mutual funds and exchange-traded funds, or ETFs, are professionally managed collections of stocks, bonds, or other assets. They offer instant diversification and are a great option for beginners who want a hands-off approach. Real estate investing involves purchasing properties to generate income or capital appreciation. This can include rental properties, real estate investment trusts, or even crowdfunding platforms. Now that you know the basics, how do you actually get started? First, define your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Clear goals will help you determine your investment timeline and risk tolerance. Next, create a budget. Understanding your income and expenses is fundamental to identifying money you can invest. Automating your savings and investments can make this process much easier and more consistent. Then, open an investment account. This could be a brokerage account, a Roth IRA, or a 401 through your employer. Research different platforms and choose one that aligns with your needs and offers low fees. Consider starting with a small, manageable amount. You don't need a fortune to begin investing. Even small, consistent contributions can grow significantly over time thanks to compounding. Let's discuss some common investment strategies that can guide your approach. Long-term investing focuses on growth over many years, often decades, riding out short-term market fluctuations. This strategy typically involves less frequent trading and a focus on fundamentally strong assets. Short-term investing, on the other hand, aims to profit from quick market movements, often involving more active trading. This approach generally carries higher risk and requires more active monitoring and research. Dollar-cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This helps reduce the impact of market volatility and can lead to a lower average cost per share over time. As you embark on your investing journey, be aware of common pitfalls to avoid. One major mistake is making emotional decisions. Panic selling during a downturn or chasing hot stocks can be detrimental. Stick to your long-term plan and avoid letting fear or greed dictate your actions. Another error is failing to diversify. As we discussed, putting all your capital into one asset is incredibly risky. Ensure your portfolio is spread across different asset classes and industries. Finally, avoid trying to time the market. Predicting market highs and lows consistently is nearly impossible. Focus on consistent, long-term investing rather than speculative short-term gains. Investing can seem complex at first, but by understanding these basics, you're well on your way to financial success. Remember to start small, stay consistent, and always continue learning. Your financial journey is unique, and with patience and informed decisions, you can achieve your goals. Thank you for joining us on the basics of investing. We wish you success in making your money work for you.
Thanks for watching our video from Online Profit Network. Subscribe now for more valuable tips and insights to boost your online success.